between institutional order flow and interbank order flow. What are the difference? What are the differences between the two, rather? If we have an idea that the market is wanting to be bullish, okay, in other words, it's a bullish buy model, okay, or in a buy program, what we're looking for are up close candles to be broken because they would otherwise be bearish order blocks, and we want to see down close candles find support. So let's zoom in here and I'll give you some ideas about what that means. So we have a smart money reversal here, and then from that point on we want to see up close candles over here, up close candles being smashed through. Okay, market comes down, trades into a bullish BISI, buy side imbalance, sell side inefficiency, fair value gap. Price starts to go higher. Every down close candle, when we trade back into it, it supports price and sends it higher. This is the largest down close candle from this move here. The market trades back down into it. Does it go higher? Yes. Market comes back down again, trades inside the order block, it leaves it. Now we have these two down close candles. Take that range out in time. Does it rally from there? Yes, it rallies. We have the last down close candle here. That's the bigger bodied candle between that one and this one. When price trades back down to that area, does it? Well, it doesn't really quite get to it, does it? It gets the high 97.08, the low 97.52. Okay, so what is that? Okay, so the high on this comes in at 97.08. Okay, so 109.70, and then the low on this comes in at 109.71. So it was only off by 1 pip, but we rally. Fair value gap is closed in here. We rally up, down close candles. We trade above it. Is it supporting price? Yes. We have displacement, down close candles in here. The high 109.84. Market comes back down into the low 109.84. So is the price being supported there? Yes, we rally. So what is institutional order flow? Bullish. Down close candle, is it finding support? Yes. Down close candle, is it finding support? Yes, rallies. Down close candle, is it finding support? Yes. Down close candle, is it finding support? Yes. Does it rally? Yes. So as we're looking for price to go higher, we're looking for down close candles to act as support levels. Okay, not just an entire range, but we're going to calibrate every one we come into contact with in regards to a down close candle. For potential bullish order blocks, we're looking at the high and the open, and in the mean threshold of the body. Those are the 3 levels. Now those 3 levels are further calibrated to the nearest 5 level and 0 level. So the nearest one you would trade to, that's the one you look at for buying or looking for support to be provided for price action. Now the difference between institutional order flow and interbank order flow, we have to zoom back out a little bit. Okay. Interbank order flow is where we have the imbalances here. We have a buy side imbalance, sell side inefficiency. So all of this creates a gap. The market wants to come back down into that area, and that's where interbank will have their orders collected. Institutions, and yes, some measure of interbank is inside of institutional order flow, but largely it's institutions pairing up with the central bank to provide the order flow that you see on your chart. Interbank order flow is going to be where there are gaps. Okay, and what do I mean by that? And all of this area in here, where there's SIBI, sell side imbalance, buy side inefficiency, all of this area here is going to be layered interbank order flow. So all of this area here where it was all imbalanced to the downside. Too much sell side, not enough buy side. In other words, it only went down, not enough up movement in here. Look inside this shaded area, how much time they spend working in that range. You see that? All of this is where interbank is going to be working a lot of future price delivery. And you see it happening here. In this area in here, right there, we have again another section of SIBI, sell side imbalance, buy side inefficiency. In other words, only one single candle passed between this candle's low and this candle's high. So all of this is imbalanced to the downside. The market will want to efficiently trade to the upside. The market trades up, passes back down to this level here. Let me show you the low at 110.03, right into here. So you can see we're working inside that range as well. And we come back down into it again here. We touch it here. We touch it here. These levels are not random. Okay, it's not just static noise. It's reacting to this range that's over here. So IPTA remembers, because of this imbalance, it understands that this area here, it wants to return back to multiple times. So you don't see this as a demand zone, okay, in supply and demand. You wouldn't see this as an area to buy because it's just simply an imbalance. They're looking for areas where there's consolidation, rally, and then that creates an opportunity to go back inside that consolidation and find, a zone. This is an imbalance. The interbank order flow will occur inside that area and respect these specific imbalance parameters. The boundaries that create the high and the low of the imbalance, or in this case the SIBI, they are what is referred to as natural support and resistance. Okay, now natural support and resistance is not the same thing as taking your levels and drawing on old highs, old lows, and expecting the market to return back to those levels and stop dead in its tracks and go the other direction. I mean, think about how many times, like this low here, did it go down to that low and stop and turn around? No. It went right through it. Well, we have a high here, and it did a pretty good job of hitting it there and then trading lower. Yes, it happened to happen there. But what about this low? Did it find support there and rally? No. What about this low? Did it stop price when it went back down to it again? No, it went lower. What about this low here when it traded down to it here? Did it stop? No, it went lower. So that's the other side of the equation. When we have imbalances like this and what we shaded up in here, that's going to be internal range liquidity. And you'll learn about that also in the core content. Interbank order flow exists outside of the chart. That means below old lows, you're going to have sell side liquidity. That's why when you're watching my annotations on my chart, you'll see below old lows or specific levels, I'll have sell side liquidity annotated. And above areas like this, I would have buy side liquidity annotated. What I'm teaching you is where the interbank order flow is, because it's outside of your chart. The chart only shows a candle low to a candle high, and everyone's worried about patterns and levels that create the high and the low. I'm interested in specific price levels above these old highs and below these old lows in the form or range of 10, 20, and 30 pips on a sweep, or 5, 15, and 25 in terms of grades of above and below old highs and lows. Because IPTA will search for liquidity in that manner. So the next question you're going to have is, well, which one do I use, Michael? Do I use a 10, 20, and 30 pip sweep for highs and lows? Or do I use a 5, 15, and 25? It depends on what your ranges are working on. In other words, from this low to this high, is it a 10 level? Like, is it a 10, 20, and 30? Or close to that? Then you'll probably have that much of a range above. Work on the 10, 20, and 30 pip sweeps. But if it works out to be like a 15 pip or a 25 pip range between low to high in that dealing range, then you would look for your 5, 15, and 25 pip, respectively, above the high, looking for liquidity. So what you're looking for is a combination of both of them. Okay, when we're in a trending move, institutional order flow is my go-to. But I'm also referring to where interbank order flow rests just above if I'm bullish, or just below when I'm bearish, because that is going to be the primary draw on liquidity. Ooh, see, there's the difference. Order flow is the momentum and how you gauge whether or not, if the delivery of price is being efficient and is it being absorbed from an institutional level. So as price is going up, that's the central bank offering higher prices. But if the institutions are not buying on down close candles, if that starts to not be evident in price action, then what you're seeing is there's a measure of distribution about to take place, and the market's going to go the other direction, or go lower in that instance. And then you would seek an area of interbank order flow where there would be an imbalance, or trade below an old low for the sell side liquidity. Everything I just said reverse when we're bearish. Where we're at right now, we do have a small little imbalance in here. I don't think it needs to go down to there, but if it does go lower, I'd like to see it find support there and then make an attempt to clear these equal highs. That's what I think is going to happen between now and non-farm payroll. What we do after that, it remains to be seen. I don't like to forecast too much with non-farm payroll. Moving on.